All right, so now we're going to take a look at problem 8-1. This is problem 8-1 on page 461 in chapter 8. Okay, so for requirement number 1, we're assuming that James Company uses a periodic inventory system. I have to prepare the journal entries for the above transactions, including the adjusting entries at the end of October, to record the cost of goods sold. So for letter A, the company purchased merchandise on account for $22,000 on October 12, 2013. Terms of the purchase were 210 net 30. James used the net method to record purchases. The merchandise was shipped FOB shipping point, and freight charges of $500 were paid. Now, because in this problem they're using the net method, you do have to record the discount first. Remember, under the gross method, you wait until the discount is known to record it, but under net, we're concerned about the discount right away. So, on October 12th, we're going to record our entry as, so this is letter A, a debit to the purchase account, and then the credit will go to the accounts payable. Now remember, it's going to the purchase account because we're not debiting inventory using the periodic system, right? We'll be concerned about inventory when it's purchased under the perpetual system, but not the periodic system. So we're going to take the $22,000 and do a 2% discount because it's 210 net 30. And we don't know for sure if they're going to utilize the discount. But again, under the net method, we have to record the discount right away. So we're going to record $21,560. Okay. So that's using the periodic method and then using the net method to record the purchase. Now it also tells us the merchandise was shipped FOB shipping point and freight charges of $500 were paid in cash. So if it's shipping point, it becomes yours as soon as it's left the dock, and then these freight charges were paid. So again, we're not charging it to inventory, we're going to charge it to the freight in. That's going to be your debit of $500, and then the credit goes to cash. Okay, so that's what we're doing for requirement number 1, letter A. Now moving on to letter B, we have on October 18th, the company returned merchandise costing $3,000. The return reduced the amount owed to the supplier. The merchandise return came from the beginning inventory, not from the October 12th purchase. So this is on October 18th. I do apologize that my writing is so choppy on this, but hopefully it makes sense. So to record this entry, we're going to reduce the accounts payable with a debit. And that's $3,000 because they don't owe the supplier any longer. And then we're going to credit this purchase returns account. Now, purchase returns will end up being included in what the ending inventory is, but we're not crediting inventory like we would under the perpetual system. We have to use these purchase accounts. So there's our credit to the purchase return. Now for letter C, on October 31st, James paid the merchandise purchased on October 12th. Well, now they paid it on October 31st. They were supposed to pay it within 10 days to get the discount from the purchase on October 12th. So they should have paid it by October 22nd to utilize the discount. Since they paid it on the 31st, they cannot utilize that discount. So we have to take it back. So they actually paid cash of the $22,000. But remember, their accounts payable that we're concerned about for this purchase was the $21,560. So we've got to reduce the accounts payable for what it was set up as, $21,560. And then we're going to debit this interest expense account for the difference, $440. And this actually gets booked right to the income statement. Okay. So now let's take a look at letter D. We have, during October, merchandise costing $18,000 was sold on account for $28,000. So remember, James Company is acting like a merchandiser. They're buying inventory and then selling it, the middleman. So how are they going to record this sale? Under the periodic system, we record the sale normally. So we have the AR for $28,000, which was our sale. It's a debit. And then the credit is the sale for $28,000. Now, under periodic, we are not concerned about the cost of goods sold. So we have no entry for the cost of goods sold. Okay. Now in E, we have to, it was determined that inventory on hand, they tell us what that was. Now again, the requirement is asking us to prepare the journal entries, including the adjusting entry at the end of October to record the cost of goods sold. So we have to figure out what the cost of goods sold is. So for E, they tell us what our ending inventory is. Or, I'm sorry, ending inventory, the inventory on hand at the end of October. In the beginning of the problem, they tell us that their beginning balance for inventory was $15,000. Let's start with that, what the beginning balance is. Was $15,000. Now we have to look at all of the entries that happened over the month. So you go back to see what were the purchases. So the purchases, the first entry that you made to purchases in letter A was the $22,000 with the 2% discount when you originally recorded that entry in A. So that's $21,560. Then remember in letter B they had a merchandise return. So we're going to do less purchases returned. Remember, you made the entry to that purchases returned account for $3,000. So that's taken out of inventory. Now, the freight is included in inventory. We included it in the freight account, but it is inventory. Freight in costs are inventory. Please remember, freight out costs are selling costs. So when you are receiving the inventory and any freight charges, you can include those in inventory. But when you're shipping it to your customers or wherever, those freight out costs are not part of inventory. they get included in the SG&A section of the income statement under operating activities or operating expenses as a selling expense. So we want to include, we'll say plus freight in of 500. So now remember what we're after. We're trying to get this cost of goods available for sale. How much did we have over the course of the month to sell? So cost of goods available for sale. So when you take the 15 plus the 21 minus the 3 plus the 5, we come up with 34,060. And then they tell us in letter E what the inventory on hand at the end of October is. So if we know what the ending inventory is, if the ending inventory is 16,060, that's how much remains. We must have used 18,000 because we had 34,060. We used 16,060. So now I've got 18,000 left, and this is your cost of goods sold number. So with all of this, we end up knowing how much is on our income statement here. So now just remember, this is the cost of goods sold that shows up on the income statement, and this is your inventory that would show up on your balance sheet. Now for the grand finale of recording the periodic inventory system journal entries. Here are the adjusting journal entries that we have to make at the end of the period. And when I was explaining this in class on Wednesday, when I was talking about the journal entries, it did say something wrong, that these are the entries that you need to know under the periodic system, and we'll see the differences when we get to the perpetual system. But when we're looking at these adjusting journal entries on 10/31 at the end of the month, we are going to book the debit to the cost of goods sold, right? That is what we had just determined at the 18,000. We're going to debit the inventory because that's how much sits in inventory. We do have to get it into the inventory count at the end of the period for 16,060. Now we're going to clear out all these other accounts. So the purchase returns, we had credited it before. Now we need to debit it to zero it out. So debit purchase returns for the 3,000. And then we're going to credit the beginning inventory balance just to clear it out of there, to start fresh at 15,000. Now, technically, you could combine these two entries and just have one debit for $1,860 if you want. That's totally acceptable. You're going to credit the purchases for $21,560 to get those out of there. And then you're going to credit the freight in. So in a sense, these accounts here, this one, the freight in, the purchases, the purchase return, are kind of like holding accounts in a way until you're closing out your inventory at the end of the month or at the end of the period. Technically, each of these ones could go into inventory, and that's how we'll see it done under the perpetual system. But under periodic, we are not adjusting inventory or cost of goods sold, either of these, cost of goods sold, inventory, until the end of the period. But please remember, we are adjusting sales and accounts receivable when the sale has actually occurred. But we're not adjusting inventory for purchases, or we're not adjusting cost of goods sold or inventory for sales. So now we'll move on to requirement number 2. Assuming that James Company uses a perpetual inventory system, prepare journal entries for the above transactions. So the exact same transactions. Quite frankly, I think the perpetual inventory system is easier because the entries are more similar to what you're used to seeing. So for letter A, we're going back. Again, they had a purchase of merchandise on account for $22,000. They had these shipping terms. Same thing, we're using the net method. If you're using the gross method, you would not be concerned about the actual discount until it's known. And then freight charges. So you'll see for letter A here, this is requirement 2. Oops. We're going to, on October 12th, debit the inventory. So in perpetual, we do debit inventory. Remember, under periodic, we were debiting the purchase account. And we're going to still debit it for the same amount, the $21,560, which is the $22,000 taking a 2% discount. And we're going to credit our accounts payable. Right, so that's what we're used to seeing when we purchase inventory. Most companies use the perpetual inventory system, so these are entries that you're normally going to see. And then when we're looking at the freight charges, we have another debit to inventory, because I said freight charges in go right to inventory for $500, and then the cash payment for $500. Okay. Now in letter B, they had a return of $3,000. It's important to note that this was on the previous beginning balance, because if it were on the purchase that was made in A, we would be concerned about the discount again, but it isn't. It's on the beginning balance. So we had a $3,000 purchase, return. So we're going to debit the accounts payable for $3,000 and credit inventory to get it out of our inventory for the $3,000. Then we move on to letter C, and James paid for the merchandise purchased. Remember again here, he did not utilize the discount because he paid it after the 10-day period that he was able to use the discount. So on October 31st, he had to pay cash of $22,000. That's how much he paid. We're going to debit the AP in the amount of $21,560 because that's what you had originally set up your accounts payable for. And then it's still going to go to this interest expense account. And that's how we record it under the net method. When you have a discount that was not used, you have to put it back. All right. Now in letter D, we had a sale of merchandise costing $18,000. It was sold for $28,000. So this entry you should know like the back of your hand. You're going to record the sale. Debit AR for $28,000 and credit the sale for $28,000. This is the same under periodic or perpetual. But now when we get to the actual cost of the inventory, we are going to debit our cost of goods sold under the perpetual system for $18,000, and we're going to credit our inventory for $18,000. And this is what you're used to seeing. But remember, under the periodic system, this entry is not made. We do make it in the perpetual system. Okay, so that's D. And then in E, it was determined that the inventory on hand at the end of October cost $16,060. Well, we've already recorded all of our inventory entries. So when you look at your T account, if you put a T account together with what was in inventory, what you purchased, what came out, what was sold, you will get to the 16,060. So for the requirement number 2, they're asking us to prepare the journal entries for the above transactions. And the cost of goods sold, we've already recorded everything that we need to. So we're done with this problem under the perpetual inventory system. So there you have it, the differences between the periodic and perpetual. I will ask that you thoroughly understand these entries, as this is a question that you will possibly see on the upcoming exam.